we're going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So
welcome to the Crypto Teacher Stock Channel. And guys, please like and subscribe if you do like what you're listening to. Please inform your friends and family and spread all over social media. It is imperative that we get back to learning finances and understand how the world really works, because once we understand how the world really works, we understand that everything is planned out. Now, of course, guys, we're going to get into the funny article first. We have Janet Yellen says stimulus is unlikely to cause inflation problem. We know the Fed printed 20% of all money into existence in 2020. Now we have another $2 trillion on the balance sheet, and it's not going to cause inflation. Now, guys, we know she knows better. But we know what the fix is. The fourth industrial revolution, the drones, the robots, the cryptocurrencies. Now we have oil and bank stocks rise as the opening of the stock market was down, but as you see, the Dow creeped up. But I'm going to talk about that later. But we still have the NASDAQ Russell 2000 not looking so good. But we have $86 billion of the stimulus package is going to bail out these union pensions. And guys, I've done several videos on the pensions. Our pensions are bankrupt. I don't care if it's union or not. They're bankrupt. The reason why, guys, because we don't have interest. Parts of the globe are in negative interest rates. And when they manipulate these yields again, we'll probably be back in negative rates. As we see, Japan is going to be manipulating their yields in order to help us out. Now, we have American Airlines planned for a $5 billion bond sale. And as we see, guys, these airline stocks are recovering. Of course, you have JetBlue, you have Alaska. Guys, things are going to open back up because they want the masses back distracted. So therefore, they can move this fourth industrial revolution behind the curtain. Now we have SpaceX wants to connect the Starlink satellite internet network to moving vehicles. We have Skynet being built right in front of your eyes, guys. With the rising yields, we have EV stocks that are taking a beating. This is what you want. You want this pullback. Wait for the bleed to come out. Tesla, NIO, I'm not your financial advisor, not financial advice. Please do your own research. But we have Morgan Stanley, who likes the SPAC Fisker, which of course is EV, and right now is in pretty good pricing. And don't forget railways, guys. We have CSX. Don't forget about the dividend. But definitely, guys, these EV stocks, this is the pullback you're waiting for. So therefore, you can ride it back up. You know a dip is going to happen. Let that dip happen and then go back in. We know what the future is, a fourth industrial revolution. We know these EV stocks are not going anywhere, especially the big players like NIO, like Tesla. So definitely, guys, get yourselves in position so therefore you can benefit as it moves up. Now, looking at the actual indicators, we have the dollar up again. After hearing about this stimulus, knowing there's more money printing, the dollar is getting stronger. We had the VIX barely down. The reason why the VIX was barely down, you look at the Russell, you look at NASDAQ. They're not benefiting from this news. So definitely, guys, we know these rising yields, even though Japan is helping us out, still is going to affect inflation, and the longer end of the yield is going to keep rising as we move forward to the end of the year. And like I stated, we're definitely going to get a big correction at the end of the year. Now you're starting to hear the media saying the same thing. But yields right now are still maintaining, they're still rising. The only way that we're not going to have yields rising more if the Fed starts ramping up that balance sheet and buying more treasuries. Right now, they have not stated they will. Don't forget March 31st, the last facilities are going to be closing that the Treasury and the Fed had created. So do not forget about that, because that's going to affect the market big time. But guys, that's all I have for you. Don't forget to go to the main channel, Crypto Teacher. Learn the new economy, cryptos, blockchain. Also, like, subscribe, spread the channel everywhere. This channel, like, subscribe, spread everywhere. And y'all have a wonderful day.
Kind of interesting, but the yields in Japan fell after the Bank of Japan's governor, Haruhiko Kuroda, didn't say that they were going to widen the band on the Japanese government bonds on the 10-year. David's point is that for 5 years, more than 5 years, the Japanese have been net sellers of U.S. Treasuries. Finally, at this point, at 1.6% on our 10-year, they are now likely to be buyers because they can make a nice profit based on how cheap U.S. 10-year Treasuries are compared to Japanese 10-year and 30-year. And it might not seem that way because the rates are lower, but it has to do with currency hedged positions that you take. It's now, those have collapsed, the costs of those. So now you can make about a half of a point more on our Treasury. So his viewpoint is that takes a major risk off the table, and it's very difficult to be bearish right now. His basic thesis is that we are at the high end of the range, at least for several months, on the 10-year. And maybe the new range is 1.3 to maybe 1.7, but he expects it to be much more stable now, the 10-year. And that flies in the face of everything you guys have been talking about today, hearing about 3% 10 years. Now, he did want to emphasize something, and this I actually got this morning because it's very arcane when you look at what we're talking about in Japan and how, the currency hedging and all that stuff. He says, basically, I think rates have temporarily made the most of the move and should be more stable in the next few months, which makes it safer to be in stocks for now. Not necessarily a long-term predictor on where rates are 6 months, a year out,